you need to identify the right question that a business seeks to answer before you start the business. And it's about figuring out not the answer to the question, the business will figure that out, but figuring out the right question that the business needs to be answering. I actually spent 6 years working on that.
Today on the show, I have the pleasure of speaking with David Marra. David is the Chief Investment Officer and co-founder of Markin Asset Management, and he has a special relationship with the financial world. He has a remarkable career spanning over 3 decades, and he's currently, as I mentioned, the head of research and portfolio management and the Chief Investment Officer at Markin Asset Management. I'm really pumped and excited to have him on the show today to share his incredible insight and knowledge with me. G'day, David. Welcome to the show. How are you doing today, mate?
Good. How are you, Reed?
Good. Thank you so much.
It's nice to be with you.
Can you please rewind the clock and tell me how you made your first ever dollar as a kid?
My first ever dollar as a kid, I probably don't remember. I do remember selling the classic lemonade on the lemonade stand, in the front yard when I was very young. So that's very possibly the first dollar. But it's also possible I bet my brother on a game of Monopoly and won it that way too. I'm not sure which.
Talk to me about a bit of your upbringing and sort of the early days of your career. Obviously, you now have started and co-founded a company, Markin Asset Management Group. What did the early days look like? How did you get into the space of where you are today? What was the entrepreneurial drive to go start your own thing? And were you surrounded with people who helped you guide you along that path?
I got my education in finance at the University of Chicago in the MBA program. And when I came out of the MBA program, just a few years out, I think I was less than a full 3 years out, I founded my first, machine learning, artificial intelligence-based company in the internet search engine space. And this was back in the day when it was the Wild West of internet search engines. There were a lot more than just the 2 or so we have today. And it was the late 90s, early 2000s. And that was really my first introduction to, leading really a technology-based company and leading a development team. And I really got the bug for, how you could see data, compute, and algorithms and code really having the ability to kind of change the world, right? To really, really move things through code and data and processing it. And so I started to think about, after that experience, how I could bring, what I was educated in finance, with a more updated version of what was going on with using cheap compute and greater availability of data. And so in 2010, I founded a company that was a quantitative investment research firm. And that's exactly what that company set out to do, was to build the platform to bring a lot more compute and data and algorithmic approach, a systematic approach to trading strategies and to investing. And that ultimately led to us, first creating investment strategies for other people. And then now 3 years ago, almost exactly 3 years ago, I co-founded Markin with my partner, Matt Kinzer. And we decided to bring those strategies that we've been creating on our platform to investors, to both individual investors, to RIAs, and to institutions. And that's kind of the thumbnail sketch of the full journey, if you will.
Well, it was interesting that coming out of the late 90s, that you were already intrigued by data to help make better investing decisions, right? That's not something that you could probably look back on and be like, oh, that's a bright idea. So talk to me a little bit about that, because I think so many people listening to this interview will say, how, why did you think like that so early on, before the computer was at a stage where it was, at our fingertips and have all that information? What really got the inquisitive part of your brain to say data can help us make better financial investments in the future?
So that's actually a really good question. Not that many people ask me that, because even in 2010, like 2009, 2010, when I was starting to look for funding for the investment research firm, and I was presenting to all sorts of investment bankers and other wealthy individuals, et cetera, most people were just skeptical of the pitch. It was sort of like, what? A machine can run a portfolio? I'm not really convinced that's the case, right? And you fast forward to today, and it seems fairly obvious that, a lot of what, not all, but a lot of what goes into a portfolio is the analysis of large amounts of data. But even in 2010, let alone the early 2000s, it was obvious. So what got me thinking about it was, I think it was just literally part of it was the experience, right? Part of it was the experience of, oh, wow, I've had this technology experience, my real first deep dive into technology, and I saw it could be transformative, right? So that was data point one. Technology can really transform me. And what was the nature of the transformation at that time was, well, we were writing code and we were bringing a lot of data to the code, right? This was kind of point two. It was like, okay, algorithms, compute, and data. There's a nexus of things going on here. Then the third piece was, I've been schooled in finance, and finance is very quantitative and could be more quantitative. And I'm a kind of person that starts with a question, right? It's like you need to identify the right question that a business seeks to answer before you start the business, right? And it's about figuring out not the answer to the question. The business will figure that out, but figuring out the right question that the business needs to be answering. I actually spent 6 years working on that, believe it or not. I mean, I was working at the time, and I started by, I'm a very academic sort. I started by subscribing. You can see the journals behind me. I started subscribing to, a half a dozen or so quantitative finance journals, investment-oriented journals, and just spent 6 years coming up to speed on what was the state of the art of quantitative finance at the time. Mm-hmm. And all that time, I'm working on trying to figure out the question that potentially a business could answer. And it took me 6 years to get there, but I got there to saying that what we called quantitative finance, there was an opportunity to make it much more quantitative than it was, say, in 2005, 2006, 2008, when I was thinking about these ideas. I mean, you asked the question, what was the kind of curiosity point? I probably can't put as precise a point on it as you asked, but that's the general gist of,
right.
Kind of how it happened.
For all those people listening out there, they hear the word quantitative financing. It's like big, scary word. Break it down in terms of what it means in layman's terms for the people who are out there looking to make better investment decisions.
So any kind of investment, whether as an entrepreneur, you're investing your time and other people's money in something, or as somebody, who I used to do that, and now I do it as a portfolio manager, requires the following. It requires us to look at the facts of the world as they are and develop as unbiased a view as we can that's forward-looking of how things are going to play out. Entrepreneur looks at it in terms of how market needs are going to play out and maybe how competition is going to play out. And a portfolio manager looks at it how prices are going to play out in all the different kinds of things that we can invest in, which is these days millions of things. But it's that forward-looking view, attenuated by the hard, real, brutal facts of the world, that we have to bring together. In a portfolio, quantitative finance just means we try to have a repeatable process, right? Something that goes through the code every day and analyzes something in as unbiased a way as possible, as scientific a way as possible, so that we can, because what we're trying to do is we have to develop a view every day, a forward-looking view of where prices in different asset classes, sub-asset classes are going, and how the risks are going to evolve, and how the correlations are going to evolve. These are the big three things: how prices are going to evolve, how the risks are going to evolve, and how the correlations are going to evolve. And that's what quantitative finance is trying to take out the part that we could never account for, the part that's not repeatable, right? If your investment team changes and suddenly different people start walking in the door in the morning, you don't want your portfolio strategy to suddenly change as a result of that, right? You want to have processes which are as kind of automated, but less so than automated, more repeatable is the essentials of what we do. And that's how we can kind of get to a more stable investment process will tend to lead to a more stable, what we call a return distribution, right? We don't know what the returns are going to be tomorrow or next quarter, but we know that our return distribution, how bad the returns get, how good they can get, and what the average is, simply put, we want that to be stable, because that allows then an allocator, somebody who's giving a portfolio manager money, allows an allocator to say, okay, I understand how this strategy is likely to work in this type of market and that type of market. So this repeatability is a big thing in our industry, and always striving to do that. And a more scientific evaluation of data, which, is going to help us get there.
Completely agree with that. And I do like what you're saying about taking the human element out of it, because as a business owner myself, I know that I have people coming through my door, chief investment officers, all that sort of stuff. They're going to have a bias or a viewpoint which can harm investors' returns, who put the sort of power into you to make those right investment decisions on their behalf, right? And so you need to take that away from your team. So regardless of who's in the seat at the time, you're still following very, very defined processes to come at the same result. The next question sort of comes to mind is like, what does the portfolio focus on right now? Like, what is your current thesis and businesses that you're actively investing in? If I was an investor and say, why would I come to you, David, and not to Reed or not to someone else? What is that genesis of your portfolio investment strategy today?
Well, I'll do the pitch for myself later.
Yeah, sure.
I'll tackle the first part first, which I think is an interesting question, right? It's like kind of where are markets at these days? I think we've come through a lot of disturbance in the last few years, right? We had a great market coming into COVID, then COVID happened. We had a lot of stimulus come about, a combination of stimulus and a lot of supply chain disruption because of COVID underneath the hood produced, inflation. Supply chain normalization has now brought inflation, largely under control. But now we're in a new world, right? We're not we just haven't reverted from, now we're back to pre-COVID. We're not back to pre-COVID at all. A few things that were sort of happening before COVID and some lingering effects of COVID are still happening. So, for example, people have not gone back to offices like they were pre-COVID yet, right? It's probably some element of that is going to be permanent, right? This hybrid type of working, right? And that's affected the real estate market, particularly commercial real estate, but also individual homes and rental real estate as well. So you've got big changes under the hood in the real estate market. Inflation has taken a normal course here, a number of years to come under control. And prices are much higher than they used to be, right? And interest rates are much higher. So that makes things like borrowing money for a mortgage or for a business to borrow money to grow, so affecting growth stocks, right? They can't borrow what they used to. I mean, I used to tell people that in the easy money days, right, the pre-COVID days, right, what did you get a lot of? You got a lot of growth firms, you got a lot of SPACs, you got a lot of speculative money, you got a lot of meme stocks, right? You get these things that are a function of easy money. And while money is slowly starting to get easier, we're still in a much higher interest rate environment than we were a number of years ago. And then, of course, you have these big global challenges. You have the challenge of electrification and decarbonization to combat climate change. You have a lot of global geopolitics, which have changed as a result of the war in Europe, the fear of war in Asia, which, we're moving away from that era of globalization that you and I, Reed, have grown up into, right? This steady march toward more integrated markets is now kind of moderately reversing. It's actually in reverse. And we're getting these sort of regional supply chains that are being built up. That's a lot of CapEx. It's a lot of CapEx for regional supply chains. That's a lot of CapEx for decarbonization and global and electrification. And you're probably going to have more CapEx spent on the military industrial complex as well. So those CapEx are likely they're certainly pushing rates in an upward direction. Not that rates won't come down, but those are forces in an upward direction. So we're probably in an environment, and we're certainly in one right now, but probably certainly for the foreseeable future, an environment where rates are elevated. And that's a big change from pre-COVID, right? In addition to all these other effects that I talked about. So this has all created opportunities to kind of make money or reallocate assets to other things. The other thing that we're undergoing in the technology space is obviously artificial intelligence and all of the potential disruption that any type of automation, particularly when it comes about very rapidly, can bring about. So there's a lot of things there I put in there, but I'll kind of stop. Those are the big factors that I think that are affecting all kinds of investment decisions these days.
I think the natural question comes through the thread of quantitative, AI, sexy word called AI, but computer learning. Was any of the things that we're in today, high inflation, supply chain issues, did you have a foresight, or did your algorithm or your company have a viewpoint of this is where we were headed? At any of those things that you just listed just then? Obviously, the black swans of COVID and wars are out of your control. But I guess once COVID was here and the stimulation came, like a lot of people was like, oh, well, there's a lot of stimulus, meaning there's going to be more inflation. Thus, we need to adjust our portfolio strategy this way.
Yes, but let me explain what we have models for and what we don't have models for, right? What we have models for are things that we can model, typically motivated by some underlying theory, right? So at the University of Chicago, I had opportunity to be, front and center with a number of Nobel laureates in the economic space. And, there's a large body of economic theory. Theory is good because theory is about causality. Right? Numbers don't really ever give you causality, right? Ideas give you causality. You start with ideas. Numbers can give you correlations, but won't give you causality. So when you're looking for causal factors, it's hard to tease those out of just pure data mining, pure artificial intelligence, pure whatever. It's really not at the state of getting us very close to causality. It may get there in the future, but it's not. So when we supply and demand is equilibrium, right? When we have a supply shift and a demand shift, those will cause known changes in quantity and price, right? For example. So theory gives us a lot about causality. When we're looking to understand the causes of the world and how they fit together, potentially, and how the future is going to look, those are things we tend to use more economic theory for, and the more basic models built directly off of economic theory. Getting more to what I do on a daily basis is I don't really look forward a year from now, 2 years from now, 3 years from now, 5 years from now. That's too fuzzy for me in terms of the way we invest to see what prices are going to do over those very, very long periods of time. Obviously, over very long periods of time, for example, if productivity is declining, that's going to be bad for asset prices. We know those kind of things, but that's a very imprecise number. That's not going to tell me what to invest in or what not to invest in too much. What we are more concerned in and day out in terms of, our actual investments, and we invest in all liquid things and across all kinds of asset classes, commodities, FX, currencies, equities, bonds. We're tending to look more at what's going to happen over a period of 1 quarter, 2 quarters. And those are things then that we can quantify with models. For example, we can quantify things like what interest rates might look like over that period of time, or what growth might look like over that period of time for not only the economy, but for particular sectors and for particular companies. We obviously have fundamentals from companies that we can use to understand how they're interfacing with the macro environment and whether they're going to be able to make money or not make money 1 or 2 quarters ahead. So that's why I was hesitant to say a full out yes, because it's a no to, we have to use theory when we want to look at longer periods of time and for big things like, how is global warming or climate change going to affect things? How will supply chain disruption affect things? Those are things that economic models are pretty good at, but won't tell me as an investor precisely enough what I need to do. For those kind of things, I've got to look for individual stock fundamentals, individual fundamentals for those different asset classes that I mentioned. And in the way that we invest, we do bottom up and top-down analysis. Top-down analysis being typical macro-style analysis, bottom-up being fundamentals and pure-out quantitative analysis, risk factors and other things of that nature.
Yep. I would like to tie it back to the real estate world because we are so intertwined, and I have, as a fund manager myself, having to look, we buy commercial real estate, but having to look at where data is going, where rents are going, where sentiment from our renters are today. One of the big things that I talk about, if you give me a mic, is like, I think we've been in more of a recession than what we've been led on to be. And that's because I can, number one, look at my portfolio and say my delinquency is up across the board today compared to where it was 12 months ago. And it's getting worse, right? It is a turnstile of evictions because people can't afford, and I brought rents down, right? I brought them down. They can't afford to pay for the gas, the food, and the rent. And that stuff cannot be ignored, even in my little sphere, but it's still a data point to what you're saying to help me make better investment decisions in the future, right? The other thing we also look at on our side is we keep the models that we've underwritten deals after deal. We track cap rates and market expansions and what's the price per square foot and all that sort of stuff. And are we picking it up at a discount compared to 12 months ago? Those things are very, very important for us to then look. I looked at this deal 12 months ago. It was priced here. It's now priced here. We think this is a good discount to the market. Let's go in and buy that asset. But it's all little things in the business that I think the thing that I'm hearing from you is that you're looking constantly at data in real time to help you make better short to medium term investment bets. Because to your point, I don't know what's going to happen if Trump gets reelected. I don't know what happens to the global warming. It can both be bad and can both have different outcomes that we didn't foresee. And I bet you any model in the world did not have a COVID coming and impacting the world in 2020 if you bought an asset in 2018. I just 100%, the old saying, pro formas are never ever right. They're either grossly wrong or they're grossly to the good. So with that being said, how are you then looking at the future now, given all the things we spoke about, the black swans of the world, the COVIDs, the wars, and what are you advising your clients to do in the environment we're in today? You mentioned earlier SPAC stocks, NFTs, stuff that's very, very speculative. What's the strategy now, given we have come up, 500% in interest rates? And so that's the first question. The second question is, then where do you think interest rates are going and the market's going in the next sort of 2 quarters as we approach the election, all that sort of stuff, to make better investment decisions moving forward?
We're focused on alpha at the moment. So alpha means we think it's a year for alpha, kind of, if you want to kind of simply put it. So just for those, of your audience who are not familiar with, when a portfolio manager speaks of alpha, alpha means investment opportunities that are more unique and will offer a unique payoff rather than say just what the market's going to do. Mm-hmm. So we think it's going to be a reasonably good year for the markets. We think growth is pretty strong, barring some geopolitical thing not happening, which is always possible. But barring those unforeseens, those unpredictables, if we just look at where we're at, growth is strong, inflation has come down, and it's likely that the Fed will be lowering interest rates at some point, throughout the year and next year. And that will be good for risk assets. And it's good for growth. We think AI is going to bring, and that's why we're investing in AI. AI is going to bring productivity benefits. Productivity is good for growth and for asset prices. But we do see a lot of risks in the market. Like if you look at technology stocks, they're very, very pricey. The US market overall is very, very pricey. There are less rich segments of the market, like small caps are not as quite as pricey as, technology stocks, obviously. And that's how we're thinking about the markets this year, is rather than be in beta, which is just kind of what the market does, really be looking for those alpha opportunities, the more unique investment opportunities that offer good upside, but don't have extraordinary risks, aren't overpriced. It's not exactly bottom fishing. That's a pure value-based approach. It's a little bit different. But an alpha-based approach is just trying to look for those more unique opportunities that have a better payoff structure than, say, the market, than a very expensive market. It's going to provide you with better protection on the downside, which is something we certainly claim and believe we specialize in and have done very well. We think we've done very well in terms of, protecting investors on the downside in the last few years. So that's very important to our investors. But yeah, I would say look for these more unique opportunities that have good upside exposure, but aren't so expensive that if things don't go perfectly, you really get burned. And you mentioned a couple of risk factors that you're seeing in your industry, and those are very real. And we're following those similar types of numbers. You talked about how, you're seeing delinquency, numbers go up on the real estate side. And we're seeing that on the credit card side as well. We see that also, you see that in car repayments, for example. So, right, higher rates cause people who are in that difficult tier of the economy to struggle with those payments. And those payments are higher than they used to be because rates are higher. So you get this kind of thing. The question is, is that really going to get out of control? I mean, sitting here today, we see it as painful for certain sectors, like commercial real estate in particular, for example. But as of today, I wouldn't say that that's an economy-wide problem a la 2007 or something like that.
Right. No, that's you're correct. Like we have seen, I just very, what's the word, like sensitive to it because I'm just in it every single day,
Sure.
right? And so you see the slowdown in inventory, you see the slowdown in people not wanting to sell. But on the other side, you are seeing a lot of lending practices, lenders having to take back assets because they're undervalued and underwater today. I'm not sure if you're following that at all, but I know we're following that very, very carefully because asset values are down across the board. And for those people who don't understand, interest rates go up, asset values come down, particularly in the physical space. So are you following any of that right now? Because I know that there's a lot of lenders out there that are got a lot of debt in commercial real estate that is underwater right now.
So we invest in REITs. So we're invested in real estate vis-a-vis REITs. They have a slightly different economic structure than, say, real physical assets. The underlying asset is a physical asset, but they have a slightly different economic structure. So I'm not in the weeds of, say, like an infrastructure manager would be, or a pure real estate manager like yourself would be. But definitely they're affecting, 1/10 of our portfolio, so to speak, vis-a-vis those investments in real estate that come off of REITs.
Last question, we sort of wrap up towards the end of the show is, you mentioned that you still think it's going to be a very good year.
Yeah.
You mentioned interest rates coming down. Jay Powell, what is your crystal ball hope, and maybe it's hope is the right word, not necessarily viewpoint, on how many cuts we'll have this year, if at all, from an interest rate, from the Fed fund rate?
Here's the guess. The best guess is 4, I would say, plus or minus 1. I think the number is not so important. What the most important aspect of rates right now is that they bring rates down, and it's a very hard job to do. This is very, very difficult territory for the Fed to navigate. They need to bring rates down so that the economy doesn't stall, right? Because that's what rates are. Rates are like a plane going up, right? And then, if you get the angle wrong and it's too steep, it stalls out, right? And it's the same thing. The economy can stall out if the rates stay too high for too long, vis-a-vis, the real estate sector is just, one sector that illustrates that. So that's what they need to bring rates down so that the economy doesn't stall, because the economy is in a good state, but rates too high for too long could cause that. They need to also make sure they don't bring it down too fast so that inflation reignites, because we still do have some supply chain disruption out there. So that's their challenge. And I'm looking closely. And so this is an interface. So we look closely at how the economy is doing, how jobs are doing, how growth and all the forward indicators like orders and these kind of things about growth are doing. And growth is clearly coming down, right? So growth is coming down. It's positive, but it's coming down. That means those rates sort of have to come down. Otherwise, they could cause that stall. So the kind of things that I look for are, if growth materially weakens, I'm hoping and expecting that the Fed will act quickly to bring rates down, for example. A failure to do that would raise the probability, the likelihood that we go into a recession or something like that. So I think the Fed has been very responsive to data. They were a little bit late to the game for sure, but when they decided to get rates going up there to fight inflation, they raised them very, very quickly. I think they have the foresight to, reduce them very quickly if the data is supportive of, reducing them. That's what I'm looking for. I'm looking for that kind of very measured and data sensitive reaction by the Fed, which is the most important thing, as opposed to the number of cuts, we get, because the number of cuts is going to be dictated by the strength of growth. Right.
Did you read anything into the stronger CPI data that came out recently as of last month? I
think it's a one-off.
Like a post-Christmas type of resurgence?
Yeah, you had weather effects for January, and then you have a lot of contract renegotiations. So these are unions and government contracts, are big ones. They all go into effect in January. So they create this one-time bump in January. If you factor weather and the one-time contract changeover that you get in January, you lose most of that in inflation. So we sitting here today, we think it's a one-time bump there, and then inflation is still on a good track. But the market is more unsure about that than I am.
Right.
Yeah.
And I think that's the market sentiment is really the most important part. Like NMHC a couple of weeks back, which is a national multifamily housing convention, people are just wanting to see at least the first cut, right? You get to that first cut, I think people are then can start to be like, we haven't risen rates since July of last year, I believe it is. So trying to see a little bit more the forest through the trees, where we're going, like we as in the real estate sector, we can make money in any interest rate environment. It's just we need to know the rules to play by. And I think those rules were taken off the table and when you went from 0 to 5% in 18 months. And that was a very big shock to the system. And I think that's why we're seeing the shocks we're seeing on the real estate side. And if you've been following this podcast for a while, you'll understand those shocks. But David, I really do appreciate all the insights you've shared with us today. I could talk to you for hours. But at the end of every show, we love to dive into the top 5 investing tips. You ready to get into it?
Sure. I'll try to do my best here.
Question number 1. What is a daily habit you practice to keep on track towards your goals?
I wake up very early, what I consider very early. I'm up around 6 a.m. and I start work right away. I just get right into it. And my first step of the day is to read very, very widely, before markets open. That gives me a few hours before markets open to read the news, just to understand what's going on in the world, what's going on in the world of politics, what's just going on in the world, geopolitics, generally speaking, what the news is. I then dive a little bit deeper into the business news. Then I dive deeper purely into the financial news and all the analyst reports I get and all of that sticky stuff. My morning is like a funnel. It's like big picture. And then as the minutes tick down to the market open, gets narrower and narrower and narrower. What's
your publication of choice if you could choose one that you go to for the listeners out there?
I don't think there's any one publication anybody should focus on. I think a breadth of views is really, really required. But I stick to the usual stuff. Wall Street Journal, Financial Times, Bloomberg on the business and financial side. And then for general news, New York Times and Washington Post.
Question number 2 is, who's been the most influential person in your career to date?
There are so many influencers there. I'd probably say Steve Jobs is probably the biggest one for me. I grew up watching his career and using his products and seeing how he articulated not only how to create technology, but how to do it in a way that certainly strived to make the world a better place. He called it putting a dent in the universe. And that was very influential to me, that the reason to wake up, every day and work hard every day, ultimately, I think needs to be about trying to make people's lives better in the small dent in the universe that each of us can do. That's what motivates me. And he was always his biography is behind me there. He's been a big guiding light in my life.
Yeah, no, great. I've read his biography. Great book. Highly recommended for those people who haven't read it. Question number 3 is, what is the most influential tool in your business? We might have already spoken about it, but when I say tool, it could be a physical tool like a phone or a journal, or it could be a piece of software that you just can't run the business without. What is it?
It's code. Yeah, it's writing code. And I still code today. Yeah, code clarifies the mind. Clarifies the mind.
It
either works or it doesn't work. Right?
that's a statement I've never heard before. Code clarifies the mind. That's awesome.
We can put lots of words to our ideas, but when we actually got to sit it down and it's got to run and it works or it doesn't work, that's where the rubber meets the road.
Love it. Question number 4 is, in one sentence, what's been the biggest failure in your career? What did you learn from that failure?
My biggest failure was that first venture, the search engine venture that I talked about. I mean, certainly in terms of business, that was the biggest failure. We got into the search engine business, right when it was taking off, but it very, very quickly, consolidated around 1 or 2 players. And it was the first time for me to run something. And, we didn't make it. And I learned so much from that. I mean, that's why, I was able to stand up again and then create 2 successful companies after it. But that first failure was the foundation for everything that came after it. But it was definitely, those are hard days when you're laying off the staff that you started the company with. Those are hard days.
For sure. Probably make you into a better business owner today, I could imagine. So, but it's all part of the journey. Mate, last question is, where can people reach you to continue the conversation that'll be in your sphere? Where do they go?
Yeah, sure. Our website is a great place. And we're, if you reach out to us through the website, there's many ways to do that through the website. We'd be happy to talk with your listeners. It's markinfunds.com, markinfunds.com.
Awesome, mate. Well, look, I want to thank you so much for taking some time out of the day. Just want to reflect some of the things that I took away from today's show. I think your ability, early on to have that curiosity around code and the quantitative financial analysis to create a product within the business to systemize your investment decisions is quite profound early on in your career. So kudos to you for doing that, because I think that's, looking back, you can say like those aha moments. I don't know if it was an aha moment, but clearly something you're curious about to stumble into where you are today to help you to create a product that your investors trust you on is so important. But I do think the power of this sexy word AI is really just about the power of crunching data, keeping good data records to then make better investment decisions moving forward. Layer on top of all the other uncertainties that you don't know, the big black swans that we spoke about, and trying to have more of a 1 or 2 quarter point of view. No one has a crystal ball. No one claims to have a crystal ball. And I think as a fund manager, it's really important to understand we're human and we make investment decisions based on the best available data today. But some of that stuff can go throw right out the window when big black swans come around. So with that being said, thank you again. But did I leave anything out in that last little summary?
Well, Reed, first of all, thanks so much for having me. I've been a very enjoyable discussion. I would just say that to the investment kind of mindset of your listeners out there, look forward, but always be open to the reality of the world as it is. We come at the world with our own hypothesis, our own best guess about what we need to do and why we need to do it. But then let the data hit you in the face and change course as is needed. I think that basic skill set of adjusting to the reality of the world is one of the things that makes an entrepreneur succeed over the long run.
I completely agree with that. That's 100%. David, again, I could talk to you for hours. Thank you so much for jumping on the show. Enjoy the rest of your week, and we'll catch up very, very soon.
All right. Thanks, Reed.
Well, there you have another cracking episode jam-packed with some incredible advice from David. Remember, if you do want to go check out anything that he's got going on, it is www.markinfunds.com, MARKINFUNDS. He has a wealth of knowledge. Please follow him because it's incredible stuff, what he's putting out, and really trying to unwind some of the inner thoughts of how he's creating a business today through data-driven decisions. Super important if you're an entrepreneur starting out today. I want to thank you all again for taking some time out of your day to tune in to continue to grow your financial IQ. It's what we're all about here on this show. The easiest way to give back is to give it a 5-star review on iTunes. All the show notes from today's show will be up on my website at reedgoossens.com. We're going to do this all again next week. So remember, be bold, be brave, and go give life a crack.